Hey guys, all right. It is Monday. I know a little bit late to get this posted for you, but I had asked this question in my page, asking for inputs, your feedback on whether you prefer like shorter, little to the point content, more text based, or if you like the a little bit more weekly digest video type content like I've been doing. It seems like there's a pretty good mix of both. Decent number of you guys would prefer something like as it happens as I can, or whatever my time permits, do something more specific to content that comes out. Others would prefer a weekly digest video where I can actually go into more detail on stuff as well. So I'm gonna go ahead and do that. Do the both just short and to the point kind of stuff, or as much to the point as I can kind of content on the page, and we'll also do these weekly videos. So that said, much of what you're going to see in this video will be stuff that I've already covered in my page, and which I've also shared with my TSP groups as well on Facebook. All right, but there will be content in here that you don't see me posting on their own, like the initial continuing jobless claims data. I did not post chart, like S&P 500, crude oil, and dollar index charts like I usually do in these videos. You will be seeing those here in this video. Okay, so be a little bit longer content for you to watch, but again, some of you guys like the video type format and the detail that gets given in them. Some of you don't, so just whichever works better for your needs. I'm going to try to have that available for you, right? So better late than never. Just did not have time to work on this over the weekend, so I apologize for that. I was home on the weekend, and there's no way possible for me to do this kind of stuff there. It's too much going on there. All right, so that said, let's get to the content. All right, I'm going to go as quickly through this data as I can. Just please use your pause button if you need more time on it. All right, so we're going to start with the usual S&P 500 or TSPC fund earnings data. We just want to know what general direction the earnings are going across the index and what to expect them to do over the coming quarters, because if earnings go down, there's more justification for the price to drop. If they start turning back to the north, and especially on the further outlook, you can expect stock prices to come back up some. Right now, it's mostly, it was a slow week. Only, I think, 6 companies reported updates last week. Most of my price targets there did not change at all, as you see there. The ones that did changed by 5 to 10 points on the negative side. But we're actually 5 points on for each quarter of that did actually change. My 12-month price target dropped from 51.20 to 51.10. Again, this is based only on the earnings data. It does not factor in a lot of other factors that need to be considered. We're just trying to get a general feel for what the earnings data is suggesting should be happening. Right now, it's moving up, but flat-ish. As you see here, it's currently at 49.30. That's based only on the trailing earnings only. A quarter from now, it's supposed to go up 60 points to 49.90, and then kind of sit there in a flat-ish, ever so slightly downward range, but should pick up 4 quarters after 4 quarters. So gains are expected to come, at least for now, but this is prior to the Fed announcing its rate hike, its 50 basis point rate hike. So we'll see how these earnings estimates get affected in the coming, when the next quarter comes through. All right, so we're largely complete there with the companies reporting for the quarter. 97.2% of the index. Only have about a dozen or so more companies to report between now and the end of the year. As you see here, it's I've got the full list right here. So about 18 companies total reporting over the next 4 weeks. So those 6 of those are the first full week, or actually the second week of January. So yeah, really only 9 companies left to report during in December. That'd put us right at 500. To be just a tad less than 100% of the index, but all right. Then looking at stock and bond earnings yields. The stock earnings yield for the S&P 500 dropped back down to 243 from 254. That's positive. Well, I mean, plus 243 from plus 254. It's a drop. We don't really want to see that, but we were already in the plus 244-ish range prior to the plus 254. So it's going back down in the wrong direction. I do expect that it will flatten out more, especially next quarter. I wouldn't even be surprised if we see some declining earnings there. And that's going to really put some interest in the bond market there. All right, so 10-year bond yield also dropped, though, from plus 3.57% to plus 3.48. So makes long, and then The 10-year, 2-year curve, it dropped from it actually tightened up the inversion there from 76 basis points inverted to 69 basis points inverted, so it's tightening up some. That's actually a good sign, and that we'll kind of cover that in a little more detail in a second when we get to the bond yield chart. And average long-term bond yield, that dropped from 368 to 359. That's for those of you guys who like to know what's going on with the G fund, the TSP's G fund, what kind of growth rate you can expect out of it. Right now, yeah, it's in that 350 to 375 neighborhood is what I would expect it to be, somewhere in that ballpark. And my recommended stock bond mix will remain at 40% stocks, 60% bonds. And looking at the companies that have $100+ billion market caps that reported last week, had 3 of them: Oracle, Adobe, and Accenture. They all beat on earnings. Oracle's earnings were flat compared to last year, same quarter last year, but Adobe and Accenture were both up. However, all 3 of them had their earnings estimate revisions, or estimates revised a little bit lower to some extent. Which one was it? I can't remember. It was Accenture. One of them was very flat-ish, but leaning lower. And then, of course, Adobe, I think they had a couple of them that were lower, and one of them was flat. And looking at the full list of companies that reported earnings updates last week, here you go there. The ones in the blue are the ones with the $100+ billion market caps that I talked about. Going to our momentum buy screen here. These are the 2 companies that reported last week that have better than 10% earnings growth estimates over the next year. Those are the ones that might be hurt the least or might actually perform well if stock price actually does what the earnings do. That's usually, ultimately, one follows the other. Normally, it's price tries to follow earnings, or tries to predict what earnings do. So, if these earnings are going to continue to be looking so good, looking decently well like that, it might be a good one there. Darden Restaurants, actually, I think they might be worth considering there, especially because I've been seeing a lot of information on the consumer spending that's suggesting that a lot of consumer, demand right now is for food and beverage services, and like restaurants and anything involving food and beverage is what they're mostly spending their money on. So I think Darden might be a better position for dealing with the current conditions than perhaps Adobe. And looking at the Contrarian buy screen here, out of those 6 that reported updates last week, only one of them fit in that screen, and that is Lennar Corporation. It's a home builder. They're expecting almost 40% decline in earnings over the next year. That is not good. And we know the housing market is kind of a mess right now, so I don't think I'd really be recommending buying into these guys just yet. Now, Contrarian buy would mean the price is already on the decline and rapidly falling, whatever. Earnings are also falling. Contrarian buy is for people who want to try to buy something at or near the bottom before it turns the corner and heads back to the north. I think there's going to be some more pain to come for Lennar. That would be my best guess based on all the economic data there is available. So I wouldn't be in such a big hurry to buy these guys. There could be some dollar cost average opportunities here with them regardless, but I think their price can probably end up going lower before finding a good bottom. And looking at next week's updates, I have the 9 companies I believe I talked about. Nike is the only one of those companies with more than $100 billion market cap. However, if you look here, Carnival Corporation, they're expecting to more than double their earnings over the next year. If I recall, they don't have a very good history of beating estimates, though. So I would be a little bit concerned about that. They've been underwater at least the last 5 quarters, and they're expected to be underwater for the next 3. Personally, I don't normally touch companies that are underwater in earnings. Generally, you have to already be above water before I'll buy them myself. That's just my own strategy, though. They say they could still be worth something for you guys. They're not. You never know. It's when they're underwater in earnings, they got to have extra cash flow available, free cash available to weather the storm, if you will. Or otherwise, you're going to have to give up some outside investment to stay afloat. Otherwise, they end up going out of business without doing one or the other. All right, this week we have a constituent change coming in the index. Actually, it's effective today. All right, so this is going to be First Solar Incorporated. That's a company that I noticed that is very popular among the beginning investors. Usually when I find people who are just getting into stock investing, they always seem to have an interest in tech stocks, or also in solar power companies and in cannabis industry companies. First Solar would definitely be right there in that. They're actually both information technology sector and solar power related. They're going to be promoting out of the S&P 400 mid-cap index, and that would be because Fortune Brands Home and Security, FBHS, they spun off into Fortune Brands Innovation Incorporated and Master Brand. They had two separate companies that they split off into, basically, and both those resulting companies there are too small to remain in the S&P 500. If I recall, FBIN, I might be getting them mixed up. I want to say FBIN is going to be in the S&P 400 mid-cap index, and Master Brand will be joining the S&P 600 small-cap index and pumping out a bottom-ranked company in that index. I might have them backwards, but yeah, that's basically what's going on there. And looking at the bond yield as the close of business Friday, I mentioned that that bond yields generally dropped. And we definitely still have too much of inversion going on here, and this is not good either when the short-term bonds are all above the long-term bonds. This is much higher risk of recession. Doesn't mean that one's going to come, but there's a much greater chance that when we see this going on here, with all these short-term bonds are higher yield than the long-term, you can almost bet that a recession is going to come and be a sure winner. So that is a concern there. And now I always talk about its 30-day yield. The Fed just raised its target rate from 3.75 to 4 up to the 4.25 to 4.5 range, by 50 basis points. 30-day yield actually did get up to just below 4.2% the previous week, but it's fallen back down to below 4. And that kind of makes me a little more concerned that maybe the bond market's telling us they're definitely concerned about recession. And they don't think that 4.25 to 4.5 Fed funds rate target is going to last long. This is telling me that they're seeing a Fed pivot, back to the downside, possibly being more possible now, or at least something to be more wary of. And generally, the Fed usually increases interest rates when they know the economy can handle it. The tightening conditions, and then they loosen the rates. They bring the rates down if they think that the current conditions are too difficult for the current economic conditions to withstand. So I am concerned about this myself, and I can tell the bond market is definitely showing signs of being concerned about risk of recession as well. And looking at the S&P futures chart from Friday, I was not able to use my Ameritrade Thinkorswim platform directly live where I get you crosshairs and all that because I'm too late getting to this. So I had to end up taking screenshots before the futures market opened on Sunday. See here, we did get a pretty strong drop there last week. However, on the daily chart, we got the 50-day moving average right here. That's with this yellow line right here. That's the 50-day moving average. Might find some support there. But we're now in a pinch between the 50-day and 100-day averages. We broke down below this trend line here. However, can a new one be established right here? We don't know. We're still well within the longer-term downtrend. We're actually still on the higher end of that longer-term, not so steep downtrend. And there's actually 3 different trends that I have here that you'll see when you get to the weekly chart. And looking at the weekly chart, here's exactly what I was talking about. Have kind of a shorter, medium-term trend that was established here by these lows here, and then you have the longer-term, steeper downtrend right here that's widening. We still have plenty of support available in between here and this bottom, this worst case getting down below 3,000 scenario. I still have a 200-week moving average at 36.54, and this medium-term trend here looks like in the 34.25-ish range, somewhere in that ballpark. But it is trending downward, so it might get down lower than that as by the time it actually becomes a possible support level. Also, we have the 10-week average right here, the red wavy line. There's a possible support point there that it could be hitting now. We'll see how it goes. Let's say the 50 basis point rate hike by the Fed last week was already expected, but I think it was the dot plot that they used to kind of plan out what the final funds rate is going to be, and how often and how aggressive they're going to be with future rate hikes. I think that might be what spooked the market. And looking at crude oil futures price here, it's the daily chart. Prices are trending downward still. It did see a get up to as high as 78-ish, 77.5, 78 perhaps last week, but it seems to be on the downtrend again. However, we got 10-day moving average support there possible, or it could break down further. I know there has been some discussion, at least it was brought up by a couple people in the TSP for Swing Traders group about China coming out of its COVID lockdown, and that could result in an increase in demand for oil. Also, U.S., they just announced that they're going to buy 3 million more barrels of oil to replenish the strategic oil reserve. That could put some demand on the oil industry and put at least a short-term price spike. I don't know. I wouldn't expect it to be much, but but then the strategic oil reserve, more supply available in reserve, also can have a downward effect on the price too. So that's why I said you might see a short-term increase in price based on at least both those information. So I don't know. I'm expecting maybe we'll see a sideways movement here on oil prices ultimately, over the medium term perhaps. And looking at the weekly chart for crude oil, it's broken down below the 10, 50, and 100 week moving averages, and next support level is down here at $65 at the 200 week average. And looking at the dollar index daily chart here, we've broken down below all of the moving averages that I look at here. It looks like it might be testing the 10-day average for resistance now. So we might continue further down. I've talked about it in the past, frequently recently. As inflation is expected to decline, expect the dollar value to decline as well. When dollar value declines, usually expect precious metals and cryptocurrencies to increase in value. So now, and I do expect that the dollar index should keep declining in value, because I do have expectations for the inflation rate to keep coming down. So that could be a possible good investment opportunity for those of you guys who like gold or cryptocurrencies, perhaps. Might be worth looking at. And looking at the weekly chart for the dollar index, we look like we might be bouncing off of a 10-week moving average support possible here. We'll see how it goes, but like I say, it's just a probability that it might bounce from here, but it could continue down further. As you see here, the 10 and 200, the 100 and 200 week averages are way down here below 100, 98 and 97 respectively. So we could see more drop, and like I mentioned, I do expect a longer term drop on the dollar index value because of the inflation coming down, and it's there's always a rubber band effect with this stuff, guys. So dollar value makes it more expensive. Declining dollar value makes it more expensive for U.S. consumers or manufacturers or even the government to buy from foreign sources or to pay off foreign debts or pay down foreign debts. However, dollar value decreasing also causes demand for U.S. products by foreigners to come back up. So it always reverts back to a mean in a way. Basically, there's a sweet spot that we're trying to find, and sometimes it overshoots the sweet spot and comes back to the sweet spot. Now let's look at the economic data for last week as well as this week. We're going to start with the usual jobless claims data. This is last week's number. Actually came in lower than the previous, actually the lowest number we've seen since September. September 25 is the last time we saw a lower number, so that's looking pretty good there. Definitely an improvement over the last 3 weeks for sure, or last 5 weeks especially. And the week ending week of 4 December was only revised up 1,000 from 230,000 to 231,000. So very small upward revisions. We'd like to start seeing some downward revisions, but as long as we're kind of stable there, we're still seeing single-digit numbers here for the most part on the current number relative to its 4-week and 8-week averages. Actually, this week we're in double-digit negative, so that's actually a really nice sign there. And looking at continuing jobless claims, again, as we're still at a new high here. I forgot to take a look at when the last time was that we saw numbers this high. It's not really super high. I talked about last week how I showed a chart in last week's update showing where the current numbers are relative to historical behaviors, I would say. So so pre-pandemic, and also prior to the housing market crash in 2007, or as we call it, the housing market or the Great Recession in 2007, I think we were somewhere closer to 2.5 million at best on the continuing jobless claims before they soared upward. So we're way below that, and we're on an uptrend. But like I say, this is not something to be overly concerned with just yet. This is definitely evidence that the job market is tightening up, where it's taking longer for people to get new jobs. and actually will help with the inflation situation as well. I just want to see some stability there. We don't want to see it spike out of control. And actually, the last week, I actually put the wrong number in here. This was supposed to be 1671, not 1670. It revised downward from 1671 to 1670 previous week. All right, and then we're going to summarize what's going on here with last week's higher impact economic reports, courtesy of Trading Economics as usual. I'm going to go into more detail on these in a few on the upcoming slides here. We're going to be talking about inflation data, core inflation, as you call it, consumer inflation, and then the Fed interest rate decision and retail sales. As you see here, the inflation rate, core inflation dropped from 6.3% down to 6%. Actually was better than consensus estimate. However, forecast for next month is 6.2%. So they're expecting it to come back up a little bit. We'll get in a little more detail on that when I get to that slide. Overall inflation rate fell from 7.7% to 7.1%. That also beat consensus estimates of 7.3%. However, they're forecasting 7.6% on the next one. So that's a move in the wrong direction. However, and I think that's going to be perhaps because of holiday shopping. We'll see how it goes. I'm sure it's going to affect my projection as well. But yeah, only time will tell. We'll see how things go there. Fed interest rate, as I mentioned earlier, it was increased from the top end of 4% to 4.5%. Forecasts for the next meeting is for it to remain at 4.5%. And retail sales month over month was up 1.3% the previous month, but was down minus 0.6% this month, when the consensus was for only a decline of 0.1%. I'm going to talk some more detail on that one as well when you get to that slide, all right? So I don't think there's necessarily so much to be alarmed about there. There are valid concerns there, but I also don't think it needs to be as alarming as it's being made out to be. All right, forecast for next month is actually 0.2% positive, and that's right in that 0.2 to 0.4 positive range that I always talk about being a good target that we want to ideally be in for good, stable economic growth with not too strong inflation. We're going to look at the consumer price index now, or overall inflation data here. Very clear change in trend here, as I've talked about in my text post about this on my Facebook page, as well as in the group, as our TSP groups. Strong month-over-month growth between December and June. Now, as we get more monthly data coming in, this data will drop off the back end of this 12-month window. So this 278 is going to fall off the back end, and then the new standard to compare against will be 281.148. So if this current trend, this 6-month trend here, stays in the general neighborhood that it's in now, eventually we'll have a strong enough standard where this 296 will be now the left end of this chart, and it'll be a more solid standard to compete against, and a much shallower month-over-month growth from there on out. That'll get the inflation rate down where we want it to be. This is me showing you what my projections for inflation were prior to the November update. See here, 7.75%, or they were reported at 7.7. I just go an extra digit past. And this was what I was projecting prior to. I was projecting 7.46%. What we actually got was, I think, 7.1, if I mentioned earlier. So that was better than expected. And this is what the data looks like after the November update here. I actually did drop to 7.11%. Also, if you look at these numbers here, compare them on this screen, this image to the previous image, you're going to see that they are lower now. The previous image, prior to the November update, they were projecting 2% neighborhood for pretty much all of this 2023 outlook. Now with the November update, it's actually dropping down even below 1% here in October. Again, we'll see how things pan out. We definitely have to wait for the holiday shopping season to end and see what kind of data comes out over the next few months. And looking at core inflation, you see it's a more steady rise here. Now I will show you that the actual rate, like the actual dollar rate that it increases, it actually is coming down, but it's just looking at it visually on this graph, it's not so apparent, but you will notice it when I do show the info on the tables when we're looking up ahead. And this was my projection for core inflation prior to the November update. I had 8.27% as the actual core inflation previous month. I was projecting plus 6.2%. For November, so again, I think it came in right at 6%, so it was actually better than what I was expecting. And then as you look at here, the month-over-month dollar amount difference. Now, we had a huge increase of $6.59 from October to November. And then it came down into the 1.5 range, actually got down below 1 from February to March. Kind of went back up in the 1 to 2 neighborhood, 1.5 to 2 neighborhood between April and June, and then dropped back down below 1. So it's been a little bit all over the place, but generally speaking, the month-over-month percent is kind of trending downward, but it's a little on the volatile side. It sometimes goes up and sometimes goes down, but is generally biasing to the downside overall. And with the November core inflation data added in here, you'll see that we're now down to plus 0.595 points on the actual core inflation price index. That month-over-month amount is the lowest we've seen in this period of time that I've actually been looking at it with my spreadsheet. Year over year, you see here is 5.96, so just a hair below 6%. Just like I said, was 6% was what was reported. I'm projecting plus 5.74% next month, and eventually a drop below 4% in September. That's not good. That's not enough. We need more of a drop than that, because this is what the Fed is especially concerned with, is core inflation, and we do want to see this come down some more. So again, this is going to be some ammo for the Fed to keep raising rates a little more, regardless of what whether the stock market or the economy is going to like it. And looking at U.S. retail sales month over month, there was a minus 0.6% decline from October to November. I mentioned that we're being below expectations, and that's not what we want to have here. We want to see better than expected, because that says the economy is stronger than we expect it to be. However, so there was a paradigm, if you will, in the terms of holiday shopping season. Generally, Black Friday and Cyber Monday tend to be where the heavy shopping tends to begin, which is usually here in late November. However, some of the shopping a lot of the shopping actually started in October. And since there was more shopping done in October than there was in November, that's just naturally causing a decline, because now people are doing their shopping a month earlier than they normally are. And so if we smooth this out, we end up with an ultimately about a plus 0.7% month over month average increase from the September number. It doesn't actually work out that way. It probably ends up being a little bit closer to plus 0.6%, because when this is up, it's up from a lower standard, but then when this comes down, it's down from a higher standard. So 0.6% of a higher number is going to be a larger drop than what this will be from a lower standard. So, but average out, we can kind of expect that it was somewhere around plus 0.7% overall, and on a month-over-month basis, smoothed out, it might be plus 0.35% is what I would say. It's probably in the ballpark of smoothed out. Again, we're just trying to smooth out this volatility here that it currently exists. Can't really just go off of 1 month's indicator, guys. This could just be, like I said, just a shift there with the shopping habits. Doesn't mean that consumers are all of a sudden no longer spending their money. It's just when they're spending their money on what is what the more concern is. Also, I want to keep in mind here, gas and auto, those also get excluded on different charts here. As you see here, excluding autos, spending was up 1.2% with autos excluded in October, but it's down 0.2% in November. Again, that's about a plus 1% increase overall from September to November, or averaging out to about plus 0.5%. So just excluding autos, it looks like we're still doing pretty well here with the consumer spending, notwithstanding autos. And now excluding gas and autos, both from the data, as you see here, we have a little more, well, still strong, but reasonable, more reasonable numbers here to work with. It was up plus 0.8% in October from the September result, and it was only down minus 0.2%. So again, and then also with gas prices coming down pretty strongly over the last month, that's going to impact the first chart that I was showing you there with plus 1.3% increase, followed by the minus 0.6. So a lot of that 0.6 was actually a result of falling gas prices, more than likely. Otherwise, even without gas and autos, the spending was down again. But as I mentioned here, again, holiday shopping shifting over to October may have had a factor in that. So this is a plus 0.6 total over these 2 months, or roughly or that averages out to about 0.3 month over month over these 2 months, and that's actually right in the neighborhood we want to see it in. And looking at retail sales on a year-over-year basis, yeah, it's definitely coming down from the high in July. So we'll see how things go there. It is dropping seemingly on the fairly rapid side too, but as long as we keep seeing some kind of growth here, maybe we'll see some stability pop up over the next. I don't know. We got some strong standards here from December 2021 to February of this year, though. So this could also, if we're looking at on a year-over-year basis, whatever was contributing to these might also fall off the back end on the on the monthly data, and could help here with smoothing out this year-over-year decline here. We'll see how things go. We'll have to watch that one, though. It is in a downtrend. We do have to be concerned about that, but like I said, it's these three here. Perhaps it might not be as gloomy as this current trend is suggesting it is. And looking at the insider sell and buy data here, sell versus buy ratio, courtesy of whalewisdom.com. Insiders are definitely in a more buying mood than they are selling. We actually dropped into the bull line territory here as the previous week. It was actually above the bull line, but with later updates, between this week and the previous week, it actually dropped down into the bull range, and we're just barely outside bull range now. So what the overall stock market is telling you versus what insiders are doing seem to be two different stories. And looking at the DAT truckload freight rate data, or freight data, whatever, spot load posts are down a large amount, minus 28% overall from the previous week. But again, I talked about this last week. We had Thanksgiving involved and factoring into, so creating some volatility there just by virtue of there being Thanksgiving and Black Friday, Cyber Monday kind of stuff going on. So I don't really know what to make of this data just yet. Trucks available for spot loads are up 13%, so that's not good for freight rates. Biggest drop was on the reefer loads, and that's again probably because of Thanksgiving. A lot more food being shipped for Thanksgiving celebrations, and maybe not so much now. Might pick back up for Christmas, over the next week or two. And looking at the DAT website, now I gotta find some more consistency between what I'm actually pulling off their site on the days that I'm pulling them versus what and when they're reporting what data, because they had said that previous week actually saw an increase in freight rates because of I think because of the holiday like Thanksgiving and stuff, but or actually ramp up for Christmas, Hanukkah, whatever you will. However, the day, these dates here that I have in here, the date that I actually pulled the data myself, and the data suggests to me that it was actually still flat to, just a tad down on the van side, but flat on the flatbed and reefer side. The DAT website kind of gave a different story to what their synopsis was, but as far as the actual days that I'm pulling the data are concerned, I'm seeing different things here. Now, for average fuel prices, though, I talked about that. The crude oil futures price keeps dropping, and it's down into the lower 70 range now, or mid 70s. Also, I talked here. I had like good several consecutive weeks where fuel prices were up above 5.30 a gallon. That's for diesel fuel, but it's dropped pretty quickly here. You mentioned, you notice here it went down about 8 cents per gallon during the week of Thanksgiving. Dropped another 9 cents the week after, and then it's dropped 18 cents and 21 cents the last 2 weeks. So it's dropping pretty rapidly. That's going to be a good thing for the overall inflation numbers, and it might help keep the economy at least somewhat stimulated, and maybe give us some chance of trying to avoid a recession. We'll see, though. I don't hold a lot of hope that we'll be able to avoid a recession. I think the Fed hawkishness is going to ultimately lead to us going into recession sooner or later. And rounding out this update, we got this week's higher impact data coming out tomorrow, the 20th, or Tuesday the 20th, will be building permits data. Consensus is actually for it to drop, and I fully expect that to happen. I expect it to drop over the next 2 months here, as you see here. 1.512 million was what the last report was. They're expecting it to drop to 1.483 million, and forecasting it to drop a little bit more in January. And Friday, otherwise, nothing of significance coming out until Friday. That'll be the durable goods orders and the personal income and spending, or basically it's personal consumption expenditures, I believe is what the report is, PCE. That report will be coming out. These two here are part of that, if I recall. Durable goods orders are, they were up 1% last month, but are expected to drop by 0.8% this month for November, and another 0.5% decline in December. In January. Personal income was up 0.7% and is expected to drop to plus 0.3% on a month-over-month basis in November. That's actually right where you want to see it. And forecast for January is also for December, whatever. I'm getting these mixed up. Keep saying November. This is October. This is the consensus estimate for November, and then this is the forecast for December, basically. Personal spending also declined, or it's expected to decline from plus 0.8% month over month to plus 0.2, and then eventually plus 0.3. Again, 0.2 to 0.4 range is right in the sweet spot. I want to be seeing it myself. Well, it's going to be a wrap for this week's update for you. Next week, not going to be too busy. Like we mentioned, there are only about 9, I think it was, companies I said reporting updates on the S&P 500, and only Nike being the only large company in that group, or company with $100+ billion market cap. Not a lot of economic data either. Housing data, we already know, is we're already expecting it to be in the wrong direction. Just same thing, different story there, really. So pretty much sums up everything. Just keep your eyes out on my Facebook page or the groups for future updates. Probably post something about the housing market report sometime on Tuesday. Otherwise, you probably won't get any more updates from me until Friday or sometime over next weekend, right? All right. Thanks a lot for hanging out and taking the time to watch all of this information. Hope you got some kind of input on it. You got maybe some impressions of your own about the economy and stock earnings. Again, stock earnings are a really strong indicator of what to expect from share prices when you're looking at the stock market, okay? I might also want to point out, because it never fails, some of you guys think that the stock market is the economy. No, it's not the economy. Stock market is just a bellwether. When you're buying stocks and selling stocks, you're doing it in relation to a specific company. And it's related to whether that specific company is expected, you're expecting their earnings to increase or decrease. So the more their earnings increase, the more their share price goes up. The more their earnings decrease or expected to drop, the more their share price drops, right? So this is why this information is important to pay attention to. What's going on with the broader stock market, because we're looking at stock index funds when it comes to retirement accounts, or TSP or other 401k accounts. Is generally just stock and bond index funds. All right, that said, though, I'm going to go ahead and call this one a day. Thanks for watching. We'll see you next week.